This episode is brought to you by Marqeta, payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome back to the Fintech Takes podcast. Today, I have an interview with the one and only Jen Tescher, CEO and founder of the Financial Health Network. Now, if you know Jen or the Financial Health Network, you probably have a good sense of what this conversation is going to be about. We talk a lot about the state of consumers' financial health. We dig into research recently published by the Financial Health Network that shows that consumers spent about $455 billion in fees and interest in financial services in 2024. We talk about the impact of student loan debt on the balance sheets and psyches of consumers. We debate, is BNPL good for consumers? Is it bad for consumers? Is it a little bit of both? We talk a little bit about agentic commerce and the need for agentic AI to evolve beyond just making it easier to sell consumers more stuff. We have a very interesting conversation about insurance and the need for a better approach to helping consumers, particularly lower income consumers, think about risk management and the trade-offs associated with it. And then finally, we talk about the need for financial health product standards, which is something that the industry has sorely needed for a long time. And the Financial Health Network is now providing with seemingly really good uptake so far. So very excited to get an update on that and a whole bunch of other topics from Jen, who is always a wonderful person to talk to and to pull these ideas apart with. So without further ado, here is my conversation with Jen Tescher, CEO and founder of the Financial Health Network. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Jen, thanks for coming on the podcast.
Good to see you, Alex.
It is lovely to see you too. We are doing this remote, even though we had already done a version of this podcast live from the MX Money Experience Summit in Salt Lake. But unfortunately, the audio was not a good enough quality for us to be able to share that. So I appreciate you indulging me a little bit more than you already have to come on and talk to me about financial health and all kinds of other topics.
Listen, 2 times with Alex in 2 months is like pure joy. And that other conversation was really awesome, people. You do not know what you're missing. We will try our best to make it as magical as that first time.
That's true. That's true. I mean, there's nothing like in person. And we did touch on a bunch of stuff. I feel like it's going to be like the lost podcast tape that everyone talks about, but like no one knows what was really said on it.
You must have a bootleg somewhere.
That's right. That's right. Exactly. So we'll have that. But I'm looking forward to this conversation. As I have expressed in many newsletters and many podcasts, I am a huge fan of yours and of the work you guys do at the Financial Health Network. So delighted to have this conversation.
It's a mutual fan club.
Oh, well, that is very, very nice of you to say. So let's start with a little level setting on the state of American consumers' financial health, which is your bag. You guys have released a ton of great research recently. There's a couple that I wanted to ask you about, and I won't make you just endlessly recite statistics. I sort of want to talk about what you think is happening behind the statistics, but just to level set. You guys very recently released, and by the way, we'll include in the show notes links to all of this for folks who are listening so they can go read the actual research, which is spectacular.
Terrific.
But you released a report called the FinHealth Spend Report, which you guys have been doing for a while, which found that in 2024, U.S. households spent $455 billion in interest and fees in 2024, which was nearly $40 billion more than in 2023 and almost $100 billion more than in 2022. And I wanted to ask you about this because I really do love the idea of trying to measure and get a sense of just in aggregate how much are households spending on fees and on interest, because, I don't know, it's kind of the other side of like the earnings reports that we get from banks, right? Where like banks are talking about, hey, net interest margin, or they're talking about non-interest income. And it's like these are sort of like abstract words that we don't connect to households and consumers. But of course, like those fees and that interest are being paid by someone. And so I'm wondering if you can put this number in a little bit of context. 455 billion. Obviously, that's increased a bit in previous years. Is the rate of increase continuing to go up? Is it sort of modulating a little bit? And like, what's driving that increase?
So it continues to grow significantly.
Hmm.
And there are two big drivers. One is credit card spend,
Yep.
and the other, particularly this year's student loan debt.
Hmm.
Because as we know, all that debt came back online
Yeah.
in terms of people having to start to make payments. And it's causing a world of hurt for folks,
Hmm.
some of whom hadn't had to pay since COVID, when
Yeah.
there was a pause. And
Hmm.
so, but credit card spend in particular, absolutely through the roof. And
Hmm.
that is a sign to me, not just that we're profligate spenders in this country, although,
Hmm.
70% of GDP comes from consumer spend,
Yeah.
but it's more and more people not being able to make ends meet or needing to leverage their credit card
Hmm.
or buy now, pay later or other things like
Hmm.
that
Hmm.
to make it through the end of the month. And it's very hard to dig oneself out of credit card debt once it's started. So I take
Hmm.
this as a canary in the coal mine kind of
Hmm.
sign
Hmm.
of where the broader economy is headed.
Yeah, well, I think that's the right way to read it. And, it's interesting because to your point, I mean, all the numbers suggest that we are right back to or having exceeded where we were pre COVID in terms of overall consumer debt level. Obviously, credit card is kind of the biggest lever that drives that. I did want to ask you specifically about the student lending component of it because I don't know that I've seen a lot of specific conversation around just the impact of student lending debt on overall household financial health. But it is really interesting, right? Because obviously we went through this kind of COVID period and, and you guys tracked this all in your data that you were looking at over those years. But, during COVID, we both saw an increase in the amount of money that was in the pockets of consumers and households thanks to stimulus. But we also saw this like kind of burden temporarily lifted off of people with student lending debt and needing to repay that. I guess I'm curious just broadly, like, how do you think about the impact of student lending debt on households' overall financial health and just sort of trajectory, right? As you try to sort of establish, especially kind of earlier in your life, like a good path towards financial health and wealth building. Like it feels like student lending, the burden seems maybe particularly acute since it just got dropped back on everyone after a break. But like this has been a weight that's been building slowly and slowly over time, right?
That's right. Let me just share a couple of key stats.
Mm,
In 2024, which is the
yep.
year that this report is measuring,
Hmm.
fees and interest on federal student loans more than doubled from the
Mm,
previous year.
yeah.
Uh, that's enormous. So combined, it jumped from nearly 26 billion to
Hmm.
over 42 billion. So
Wow.
just the sheer size of the burden is
Hmm.
significant.
Hmm.
It's also really important to mention that uh, the challenges people face are not equitably distributed.
Yeah.
So people who make lower incomes, people who are Black and brown, people who are subprime borrowers are far more challenged by this debt. And for that matter, they're all spending way more as a percentage of their income on financial services fees and interest. So 37% of the households who are currently making student loan payments report repayment challenges, either missing a payment, late payment, or foregoing essentials to stay current. And that's now, right now. So I expect that to get worse. What's interesting about student loans is I absolutely agree that the challenges, the sheer size of the burden, it appears to be influencing the behavior of younger people
Yeah.
in terms of household formation,
Hmm.
um, uh, thinking about buying a house, for instance, or even buying a car.
Yeah.
And I think it also affects their overall psyche, feeling
Hmm.
like, am I ever going to get ahead? But it's
Yeah.
important to note that student loan debt doesn't just affect the student. In
Mm.
many cases, these are folks who are in their 30s, 40s, 50s who have been
Yeah.
carrying student loan debt their whole lives, or they're the
Yeah.
parents of students who are carrying that debt.
Yeah.
So this really cuts across a very broad swath, excuse me, of households.
Yeah, well, I'm glad you mentioned that because it is something that impacts kind of the broader sort of financial health picture for entire households, right? It's not just these young people. Like, there's a very like kind of narrow, I think, understanding of student lending debt, and then there's sort of like the broader, almost like social context of student lending debt. And I
Absolutely.
think it is really interesting to think about it because the other thing that it makes me kind of think about, and I'm fortunate enough to have been far enough removed from going to college that like I'm sort of not in this phase, but it does sort of strike me that we're going through a bit of a reset just in terms of like the broader social contract that we've had in place for a long time around like, go to college, get a good white collar job. Like, we're already seeing that signs that might be changing. And this could be due to AI or the changing nature of work. I noted with some dismay that not only have student loan repayments restarted, and now we're now furnishing data to the credit bureaus if you're missing your student loan payments, but coming up next year, I believe in May, the government is going to start collecting on people who are delinquent in paying back their student loans. And it struck me as interesting that federal student loans, there's actually quite a few things that the government can do if they want to get paid back, including like taking money out of your tax refunds and all kinds of things that are a little bit more potentially punitive or have kind of a bigger impact on people's households. So I do think, like, to your point about the psyche of people who are carrying this debt, like I would imagine feels to them almost like the entire sort of economic compact that we've had for a long time has sort of shifted under their feet, which is going to have larger impacts than just the amount of debt that you're holding at this exact moment.
Yeah, I agree. It's a real albatross for
Hmm.
so many people. Um, if I'm not mistaken, federal student loans are also not dischargeable in bankruptcy.
Yes, that is correct.
And so it's one of the few forms of debt out there that there is almost no way to
Hmm.
get out from under. And a lot of people uh, were critical
Hmm.
of Biden's attempts to forgive lots of the debt
Hmm.
um, because of the way he was doing it.
Right.
But the other thing that's been happening over the last, I don't know, 4 or 5 years is
Hmm.
this roller coaster ride for debtors of,
Mm.
is it going to be forgiven? Is it not going to be forgiven? Oh, he said
Yeah.
it's forgiven. Oh, the court says it's not forgiven. Oh, I have to
Yep.
pay. Oh, I don't have to pay. So
Totally.
a tremendous amount of uncertainty and confusion. And
Hmm.
whenever there is uncertainty, what do? You sit in place. You don't
Yeah.
make
You wait.
changes.
Hmm.
You don't make decisions. So yes, I think it has huge impacts. My sister in law, who's about to have a second baby,
Hmm.
and is in her uh, early 40s,
Hmm.
has been working at a nonprofit for almost 10 years now so that she can get the loan forgiven under that
Mm. Hmm.
program, where if you work in
Hmm.
the public sector, or
Hmm.
nonprofit sector, after 10 years, it'll be discharged. And
Hmm.
she's very concerned. She's almost there. She's got 14 more months or something.
Yeah,
And
yeah.
she's very concerned
Mm,
that the rules of the game are going to shift. And all of a
yeah.
sudden, that's not going to be the case anymore. So,
No, I mean that's exactly the problem, right? Is that I think, we talk about the impact that uncertainty has on like companies and the ability for companies to make investment decisions, and tariffs and all these things are like bad for companies. The same type of uncertainty affects households, right? And the way they make decisions, and
hugely.
not just like the plans they make about what job you're going to take, what city you're going to live in, what assets you're going to try to save up and acquire. Like all of these things are downstream of these earlier financial things. And when we throw those into uncertainty, it has a really big effect. Jen, I also wanted to ask you, you referenced briefly buy now, pay later. And was really curious to get your take on buy now, pay later, because as I have written about numerous times in the newsletter, I am just so I don't want to use the word torn. Like I'm so just perplexed by buy now, pay later, because in a lot of ways, I think it's a very, very good thing. In a lot of ways, I think it creates sort of new or interesting challenges for consumers and households. And when I was looking at the data from this report, it's indicated that buy now, pay later usage, at least at a broad level, has held steady at about 16% in 2024, which it sounds like is sort of unchanged roughly from prior years. However, it did indicate that sort of beneath the surface, the number of BNPL loans that users are taking out kind of continues to inch up. And as shown up in your data and has been reported elsewhere, there's a slight uptick as well in borrowers maybe having trouble making payments on their buy now, pay later loans. I was curious beyond that data necessarily, just to get your take on sort of the impact of buy now, pay later on the larger picture of consumers' financial health. Because again, depending on the way you sort of squint and look at it, I think you can see it as being a healthier alternative to revolving debt on credit cards, which, as you said, is just enormously difficult to get out from under once you get stuck in that sort of trap. On the other hand, I think, I've talked to numerous young consumers who are like kind of somewhere between 17 and 25, whose entire sort of mentality around consumption has sort of been shaped by the omnipresent nature of buy now, pay later. What do you think the impact of buy now, pay later is on consumers' financial health?
Yeah, I am like you, Alex. I am really torn because this notion of pay in four or pay in six,
Yeah.
like of installmentizing, if you will, a payment, um, is a great idea on paper. Um, but the way it's been executed with buy now, pay later, um, has led, I believe, to overconsumption, um, to consuming in ways you don't even realize, because it's very hard to track across.
Yep.
And I also think that, as you pointed out, it's becoming the norm. So the lack of friction
Mm-hmm.
is, we are continuing to reduce and reduce and reduce payment friction.
Yeah.
And I think we've now gone too far. We've
Mm-hmm.
removed too much. I
Mm-hmm.
would say the same thing about the agentic commerce to come.
Yeah.
Um, like we are at the point of potentially taking away too much friction. And so I'm very concerned about that. An important piece of data from our study is that
Mm-hmm.
60% of those who use BNPL reported taking out three or more loans.
Yeah.
That's up from 53% the year
Mm-hmm.
prior. And
Mm-hmm.
of those with multiple loans, 41% of them borrowed from more than one provider. That suggests that loan stacking may be taking place.
Yeah.
And um, we have got to figure out a way for these loans to get reported,
Mm-hmm.
whether it's a closed bureau
Mm-hmm.
amongst the BNPL lenders, whether
Mm-hmm.
it's through the broader credit bureau system. We have to do that,
Mm-hmm.
so that the lenders themselves can take into account whether someone's got other BNPL loans. It seems so obvious. It seems so
Totally.
obvious that it's ridiculous that we have to say it.
Totally.
But I'd love to, let's see what happens when we do that. I'm holding judgment for that.
Yeah. Yeah. Yeah, no, I mean, Jen, you're preaching to the choir. I've been like screaming into the void about furnishing this data somewhere and sharing this insight, but you're exactly right. And I think that, one of the things that's really challenging about buy now, pay later is, and I think agentic commerce is another really good example of this. I think one of the challenges, and say what you will about credit cards, and I could say plenty of things, and I have said plenty of things about the problems that they cause for consumers, but there is something to the idea that if I'm going to underwrite you for a lot of credit, I am going to be taking risks as a lender that are somewhat aligned with the risks or your usage of this product, right? And one of the things that disturbs me a little bit about pay in for buy now pay later is because we're underwriting people transaction by transaction by transaction. The risk to the provider is actually really small, right? Some people talk to me about like, oh, do you think buy now pay later is going to blow up and there's going to be this huge like credit problem in buy now pay later? I really don't, right? Because like as soon as the water starts getting right to the top of the bathtub, you just turn the tap off and like it's fine. Like it's very granular in your ability to control risk. But the flip side, I think, is also true, which is that it allows these providers to sort of fill households up with like the maximum amount of debt right up to the very tippity top without it getting tipped over the edge. And I think the better we get at sort of underwriting every last little pocket of liquidity that consumers or households have, I mean, it has to have like a subverting effect on savings and investment and just like the cash flow like bandwidth that households have, right? I mean, like we're in some senses, I think we're getting too good at underwriting and making payments frictionless and like finding all of these little pockets of liquidity being like, oh, hey, I saw you just got a little extra money because of this gig and it came into your checking account, like, hey, we can help you spend that. I mean, we're getting really freakishly good at that side of the balance sheet.
Yeah. Yeah. I think that's really well said, Alex. And it really harkens to what's to come with AI,
Yeah.
because on the one hand, I'm very excited
Mhm.
about a tool
Yeah.
that can know you and your
Mhm.
financial situation and your proclivities and your risk tolerance, can know all those things and help you navigate.
Mhm.
But if that agent, that bot, is not acting in your best interest,
Yeah.
uh, then game over.
Yeah.
Because yeah, it will be single-mindedly focused on getting you to spend every last dollar. Um,
Yeah.
and so I'm really interested in, and FHN is actually about to do a small workshop bringing together a range of stakeholders focused on AI navigation, AI navigators for financial services, to really start to identify underneath that banner what are the most important use cases, what are um, the use cases that uh, consumers themselves say they want the most, and that we think are going to be most beneficial to their financial health, so that we can start to encourage more innovation around those spaces, and not just reordering your detergent without automatically for you. I just sorry, but I can't get too excited about that.
I'm with you. I'm absolutely with you. I mean, I feel like on the agentic front, I'm glad you brought this up because I wanted to ask you about this. I mean, the challenge oftentimes is, we always talk about, oh yeah, in financial services, we want to listen to the customer, we want to build what the customer is asking for. And as it relates to AI, I don't feel that way at all right now, right? Like the whole
Oh no.
conversation around agentic commerce is a great example of this, where it's like, look, to be totally candid with you, I don't have a problem with e-commerce and online shopping. I'm great at online shopping. You know what I mean? Like I could not be
Skill
better
on your
and more
resume,
like
right?
God, I'm incredible at it. And as good as I am, my wife is 10 times better at it than I am, right? Like we are a really great household when it comes to shopping. We have no problem finding products. We have no problem checking out. Like it's already really frictionless. I feel very empowered to shop online. I don't need an agent to take more of the work off of my shoulders. And when I look at the enthusiasm that Visa and MasterCard and PayPal and Google and Stripe and
Yep.
OpenAI have about agentic commerce, it strikes me the wrong way that they are like rushing us towards this future, because what they see is the opportunity to take the human being even more out of the process, right? Like, probably the most annoying thing to Visa about online commerce today is there's still that pesky human that's like looking at the things in their cart, and they're like, gosh, sometimes they pause, sometimes they take the things out of their cart. We put buy now, pay later in place so that we could reassure them that they could afford it, and that helped, but still sometimes people will like save it for later, and gosh, that's annoying. Wouldn't it be better if we just had agents that were handling this and that never had any second thoughts? I rant about all of that just to sort of illustrate your point that I feel like the thing that consumers probably are more wanting and asking for and aren't being heard is, I want help considering purchases. I want help thinking about,
That's
okay,
right.
I want this thing. I am willing to wait a year to get this thing. So what I would like to do is have you, agent, passively just wait and search and monitor. And when you find what you think is the absolute best deal on this that I'm going to get over the course of the entire year, grab it for me. Or, and this bridges us into kind of the broader conversation I wanted to have about this. I'm not getting a great interest rate on this loan that I took out, 2 years
That's right.
ago, and that I'm still paying interest on, as we were talking about before, with the level of interest and fees that consumers pay. It's a ton of paperwork to refinance a loan. There's really no reason everyone shouldn't be refinancing all the time. We just don't, because there's so much paperwork and annoyance in the way, and it's not our job in our daily lives to track, the level of interest and like how much I can save if I refinance. I actually have an agent that does that. I'm sort of alarmed,
Right.
Jen, that I don't see a lot of banks or other providers rushing to build like the thing that's going to
Right.
provide value when it's not necessarily aligned to their bottom line. How do we push for that more? It sounds like you're working on that, but what are your thoughts on that? When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more.
Yeah. So I love the examples you've gave, because it just demonstrates that we're focused on the wrong friction.
Right.
We're focused on the friction that that by reducing it, we enable people to spend more and sort of fatten up the coffers of the companies involved. We don't focus enough on reducing the friction that would allow people to get a better deal,
Yeah.
or to better, frankly, that would help them be their better selves.
Yeah.
We all have these challenges. It has nothing to do with how much money we have.
No.
In terms of the being able to wait, for instance, for something we might want, or making, decision making is filled with challenges called our brain. That's just the way our brains work, right? I eat the donut. I'm the person who cuts the donut in half in the break room, eats that half, and comes back later and eats the other half, right? Like
Totally.
And as human beings, there are so many ways in which technology and other things can help us be our best selves. And these things that we've been talking about are doing the exact opposite.
Yeah.
I think that it's not surprising, right, that this is happening, because companies are going to go where they can monetize the quickest, or where they're most concerned about, the race, and someone else surpassing them. But I kind of feel like, in a way, this takes me back to the mid 2000s, before fintech was a thing, after the commercial internet came online, and it was, hey, let's try to generate some enthusiasm for innovating around these kinds of financial health challenges. And a whole cottage industry of sort of mission aligned capital, mission aligned funds. Even the
Mm-hmm.
big banks got into the act,
Mm-hmm.
you know, created space and money and time for folks to develop those kind of solutions. And I think it's a big part of the broader fintech 1.0 story.
Yeah. Yeah.
And now that we have AI, which sort of I liken, it's going to be even bigger than the internet probably, but it's sort of that next transformational moment 20 years later. I think we now need to do the same thing. We've really got to crowd in capital and space for innovations that may make money, but it may not be tomorrow. And it may not be like the immediate next thing. And I feel like the race around AI and the feeling like, oh my God, it's happening and we have to move so quickly, and that causes some very short term thinking, and we've got to create some space for a little bit longer term thinking, because the fact is, even for the fintechs who are developing in this space, they are going appropriately slower, because when you put one of these tools in front of a customer for something other than buying their detergent, you've got to make sure it's going to be right.
Totally.
And so, so that makes me feel slightly better that some of the biggest innovators,
Yeah.
individual innovators that I see, I feel like are really taking this with appropriate speed. But I do very much worry about once the big guys come in,
Yeah.
that they will move too fast and break things.
Yeah. No, I think that's right. I mean, I will say to your point, the conversations I had at Money 2020 recently that were all very AI heavy, as you would imagine, I was actually impressed with the level of like nuance people were bringing to the conversation about like, well, we think we can use these models here, but we don't think they're as good a fit here. So I do think even in the last couple of years since ChatGPT was released, I think we've definitely leveled up our sort of understanding of this technology and what it's good at, what it's not good at, where it might help us differentiate. And I like your point about sort of fintech 1.0, like there will just be opportunities laying on the ground for someone to pick up that will be so obviously good for consumers and so differentiated from what everyone else is offering. Like if everyone else is agentic commerce, agentic commerce, agentic commerce, and you offer agentic savings or agentic long-term investing or, agentic, getting a good deal on online shopping, like all of those things will be so much more differentiated because everyone else rushed to the other thing. So I do agree that I think we will see a little bit of that. I wanted to ask you kind of a conceptual question, if you don't mind,
Go
which
for it.
is I was reading another report that you guys published recently, your Financial Health Pulse Trends report, which is like required reading for anyone building in this space, and really interesting data. One of the most interesting ones that jumped out to me was a finding around insurance. The report found that
Mm,
56% of households say they are at least moderately confident in their insurance and the fact that it would protect them in an emergency, which was down slightly from 59% the prior year. And I wanted to ask you about this, Jen, because I think just conceptually, we do a horrific job in financial services of helping consumers, particularly lower and middle income consumers, think about how to mitigate risk, right? And really, like insurance is just risk mitigation and risk transfer at the end of the day. And we
right.
have several categories of very established insurance products that mitigate specific risks. Some of those risks are becoming more expensive to mitigate, right? So, like cost of health insurance going up. Obviously, everything relating to like property insurance, particularly if you live in certain states, is going up. But I also think like there's this broader question that I think all consumers feel, which is just like, hey, we're living in kind of a volatile, uncertain time. I think everyone wants to think about risk management. And, candidly, I think wealthier consumers, wealthier households, I think they probably think a little bit more about risk mitigation. And I think they can afford financial advisors and like help at like, well, how do I hedge my portfolio? How do I do these things? And so like to me, risk management is almost one of the clearest sort of dividing lines you can draw in financial services between wealthier households and less wealthy households in terms of like the access and the sophistication of the products they have. How do you think about risk management and, I guess, insurance just from like a financial health perspective in terms of the impact it has on households?
Yeah, that's a really good question. I do think that one of the reasons why wealthier people are better able to manage their risk is not just all the reasons that you gave, but it's that when you have a cushion, you can think longer term.
Yeah.
As opposed to when you don't have a cushion and you have a lot of needs, you become very focused on today.
Yeah, you're in
And
the present.
so, right. So a lot of times we criticize lower income people for making quote unquote bad decisions. But
Sure.
actually, those decisions make tremendous sense in their circumstance and with their
Yeah.
time frame in mind.
Yeah.
Like, I have
Yeah.
to just get to tomorrow. That's my
Totally.
long term. So
Totally.
I think it's important to just say that.
Mm-hmm.
And so anything that gives people an ability to not be focused on the present, to be
Yeah.
able to focus longer term, I think is
Yeah.
helpful. It doesn't have
Yeah.
to be insurance, right? It could be having some savings, as an
Yep.
example.
Yep.
I think insurance, not only is it becoming more expensive, it is one of the more confusing products
It's totally
because
confusing.
it is not, here's some money, insurance company, every month. And when this thing happens, if this thing happens, you will pay me. There's still all these kind of rules. Well, the event had to look like this, and
Yeah.
you have to look like this, and
Yeah.
I may not pay you. And as much as we might read the fine print at the beginning of the policy, 6 years later, when the thing happens, you didn't remember that exclusion.
Right.
And so it feels very much like a gotcha. It feels very much like a gotcha as opposed to a backstop. And I think that there's a lot of things in life right now for a lot of people in this country that feels like that.
Yeah. Yeah.
That feels like that company or my government or, doesn't have my back. And so I think the other thing that I'm very concerned about is climate related weather and climate related disasters, which is driving property insurance through the roof, and is leading people to have their insurance canceled. And we've done some prior research that shows that the greatest risk isn't necessarily in the communities we automatically think of, that there's lots of places around the country that have risk. And there are a lot of renters in a lot of those communities. And we know that renters are less likely to have rental insurance because it's not required as homeowner insurance is. And so I really worry for those folks who are already less able to weather, pun intended, a disaster.
Yeah, no, I think sounds exactly the way I've been thinking about it too, which is just like these risks sort of stack up. And like the renter's insurance is actually a really great example of one where it's like, I feel like as soon as you move outside of these established categories, right? Like if you have a car, we require you to have car insurance, right? If you own a home and you have a mortgage, we require you to have homeowners insurance. Like there are these categories where insurance is just sort of built into the product. But there's a lot of categories where like essentially risk mitigation is available as an option. But like I think one of the challenges, and again, it goes back to your point about, lower income folks just living very much in the moment and not sort of having enough sort of space like in their finances, just from a time perspective.
Mentally,
to think about,
they don't
like,
have
the
enough
longer
mental
term.
bandwidth.
Right, totally. And I think that for those consumers in particular, as soon as you make risk mitigation like optional, or oh yeah, if you have a little bit more time, you can go look at this, like it becomes that much more challenging. The other thing, just on the risk management front, that I find really interesting and challenging is it also lends itself to I think, more predatory product designs and sales tactics, right? And this is
Totally.
also something that I know you've spent a lot of time thinking about, and you guys have done research into, like the design of a product and the standards that you build around a product and the way that you sell a product. All of those things really inform the end outcomes for consumers. And, like, to pick on a specific example, we've had payment protection insurance in various forms in financial services forever and ever and ever. And banks in the past have gotten themselves in a lot of trouble by offering that type of insurance product, but doing it in a way where it was sold by employees at the point of sale. The pricing and the sort of incentives for that salesperson weren't clear to the buyer, and ultimately created a lot of consumer harm. That's not to say that those products themselves aren't necessarily potentially a good thing or something that should be a part of the mix, but, like, how we do these things, how we sell them, how we structure them, that matters a lot too, right?
I couldn't agree more. Thank you for that tee up, Alex.
Yeah, yeah.
Because I know you're aware of the new design standards for checking accounts and credit cards that we put out
That's
in
what I wanted to
June.
ask you about. Yeah, yeah.
And there are lots of different standards, certifications, other things out in the financial services world, but very few, if any of them, really focus on what you talked about, on the design of the entire experience. They tend to be thou shalt not charge for overdraft, right? And I think those floors are very
Hmm.
important. I actually think that
Hmm.
should be the role of regulation, is creating
Yep.
the floor.
Yep.
But I also think that we need uh, a race to the top.
Totally.
We need to create an environment in which financial services companies understand the benefit of designing for the consumer outcome, because it's ultimately better for their own business. Their customers are stickier. They're more likely to buy more products. They're more likely to tell a friend. They're more likely to ultimately have a good financial life that enables them to afford your products in the first place. And so we put out these standards, which we hope will be the first in a library of standards for a range of different products and services. We obviously picked checking accounts and credit cards and the idea of spending, where we started this conversation, because they're so prevalent. They are, in many cases, the foundation of people's day to day financial lives. And just a few weeks ago, we put out a report assessing 20 of the largest checking account providers to
Yeah.
see how they perform against
Hmm.
these standards. And the short answer is there's lots of room for improvement. Um, but what's been so heartening, Alex, is
Hmm.
that in all of the conversations we're having with
Hmm.
all of these institutions who are now assessing themselves
Yeah.
and hopefully answering our call, which is to choose a
Hmm.
standard you're not meeting today and, like, let's work
Hmm.
on that together,
Sure.
the
Sure.
response has been spectacular. These are
That's
voluntary
great.
standards. And
Yeah.
we live in a moment right now where, people aren't so worried about pleasing the regulator, because the regulator
No.
doesn't really seem to be paying too much attention. So you might say, oh, this is not the right time to do standards, that institutions are not going to have the incentive to do so. Our experience has been the opposite, that folks have really come to appreciate more and more the importance of centering financial health in their businesses. And folks are really eager to understand what they've already got on the roadmap, what else they could put into the roadmap. And they're really trying to, the questions we're getting most are, among these different standards, how do I prioritize amongst those?
Sure.
I can't do them all at once. I have a tech queue, totally
Yeah.
understandable.
Hmm.
So yeah, our experience so far has been really positive.
That's great. I mean, I'm so glad to hear that. And I, as counterintuitive as it may seem, I'm actually not surprised about that, because I do think one of the things I've sensed for a long time, and I'm sure you probably feel the same way, among banks and fintech companies is, to your point, like, there's kind of a box, I like to think of it, right? And it's like the box is defined by, we have to make money as a business, right? Like, we have
Yep.
to make money. That's one of our mandates. And then obviously the floor, as you indicated, is we have to abide by regulation and we can't do these specific things. Like we must sort of follow the law. And like that's the box that we all operate in. But there's a lot of room in that box, right? And I think that
Yeah.
where you sort of put your product within that box is much more a matter in some senses of like taste, I think. And it's interesting because to your point about standards, I think a lot of decisions that get made on a sort of kind of minute product level are just about like, well, this is how people have done it in the past, or this is how we did it at this other institution that I was at, or this is just the way that occurred to me when I was sitting down to design it. But it's not necessarily a decision that's made with like a wide angle view of all the best practices in the industry. And your guys' research into these standards and the documentation you've put together does a great job of providing like tangible examples of people who do this really well. So people can kind of learn from what this looks like. Like if you surface those, it doesn't surprise me that people would be willing to go, you know what? Like why not do it, right? Like it doesn't really cost us anything. It improves outcomes for consumers. It makes our product better. Like it's just sort of like money sitting on the ground. We might as well pick it up. And to your point, you can't do everything right away. It needs to get worked into these product roadmaps. But like I'm very cheered to hear that that's been the reception from these institutions, even though there are a lot of areas for improvement still.
Yeah. And I think when we did our assessment, we did it from the lens of a consumer. So like a mystery shop. So all of the factors that we measured on were things that you could see just as a consumer. And so one of the things we look at that you get extra points for, if you will, is findability. And so in some cases, an institution would actually have the thing we were asking about, but it was not findable within a couple clicks. And the response to that finding has also been very positive because people understand the point, which is, well, boy, if we have it, but our consumers can't find it, then we might as well not have it at all. What might we do about that? And listen, real estate is limited. You can't have everything on the front page or but how do we think about either personalizing so that we're putting the right thing in front of people at the right time or rejiggering the overall so that we're prioritizing certain things over others. There's a lot more work to do, obviously. And the standards beget questions, which beget questions, which beget, right? We could go super deep on every single one of these with folks, right? As we really get into the details. But so far, so good.
That is fantastic. And I know we're wrapping up here. I could continue to pester you with questions on this subject forever, but I won't right now. I will say, though, that I am delighted to have already committed to attend and speak at Emerge in 2026,
Yay!
Which is your annual conference. I've already told you this, I think in our bootleg podcast that never made it on the air, but Emerge was number one on my list for a conference I have not been to that I wanted to go to. So I could not be more excited. Would you mind just giving the audience just a quick tease of that event for folks who are not familiar with it?
I would love to. May 19th to the 21st, 2026 in Atlanta. And this conference has been going on now for over 20 years. It is the ingathering of the financial health community. Providers of all stripes, banks, credit unions, fintechs, vendors, you name it. Some nonprofit organizations, others who are working on the ground with consumers, government officials, regulators. It's a very broad swath of folks. And what I hear consistently from folks, aside from like we know how to put on a really good show, is that there's a level of candor and sharing that people do at this conference that you don't often see at other conferences. This isn't a big commercial for folks. These are all people who are trying to accomplish something similar and recognize that they need to learn from one another. And they're all kind of in this mission together. So for a lot of people, this is their like recharge for the year, because then they can go back to the company and they may be one of the only champions. Increasingly, that's not the case anymore. but there's still work to do within their institution, and they feel like they've got their people who are also facing the same opportunities and challenges that they are. And then the final thing I'll say is in June at our conference this year, the call to action was assess yourself against our standards, identify one you're not meeting, and commit to meeting it. And at the conference in May, we plan to showcase some of the institutions who have made those commitments. So if you're an institution, a provider listening to this, and you want some airtime and some love, give me a shout out. We'd love to feed you.
That is fantastic. Well, I could not be more excited to attend. It's like I said, it's been on my list for a long time. As you said, the conference has been happening for a long time, and it's truly like one of those places where all the people who you just really like and admire and want to learn from all spend some time sharing best practices and what they're seeing. So I cannot wait. Would highly encourage folks to register for that event and continue to read all of the research and all of the work that the Financial Health Network puts out. Jen, thank you so much for coming back on the podcast and giving me even more of your time. You're the best.
Oh, thanks, Alex. Really enjoyed our conversation.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.